Welcome to The Explainer. Today, we are breaking down a massive, fundamental shift in the macroeconomic landscape that completely flips everything we thought we knew about safe haven assets. Wall Street is sounding the alarm right now, and they're calling the long bond a danger zone. But the actual danger, well, it's not what most retail investors think it is. We're going to dig deep into the data and uncover exactly why the traditional financial architecture of 2026 has hit such a critical and, frankly, terrifying inflection point. So, the big question we absolutely have to ask ourselves right now is this: what happens when the US Treasury simply cannot be sold at any rational price? Historically, sovereign debt has been the absolute bedrock of global finance. It's the ultimate risk free asset you run to when panic hits. But here is the hook. The real threat today isn't the yield. It's the very real possibility that in the next 90 days, if you need to liquidate a massive position, you literally might not find a buyer at all. All right, here is our roadmap for today. We'll start with the danger zone, uncover the liquidity mirage, analyze the auction death spiral, compare bonds versus Bitcoin, and finally map out the escape plan. Okay, section 1, the danger zone and the death of the safe haven. Let's see how this is building into a major inflection point. Now, the number that's got everyone sweating is 4.416%. The data shows the 10-year U.S. Treasury yield fixed exactly there, up 3.0 basis points and remaining firmly entrenched in what strategists are literally calling the danger zone. But honestly, if you're just staring at this nominal yield, you're missing the much, much bigger picture. Because here is where the real alpha lives right now. We have to move completely beyond standard interest rate talk and focus entirely on liquidity risk. Most channels are out there obsessing over yields, but Wall Street is warning that the fundamental threat is a structural inability to exit massive positions without causing a total price collapse. Inside this danger zone, the depth of the Treasury market is getting so impaired that trying to trade an asset without completely destroying its value in the process is becoming impossible. To really wrap your head around this, think of it like someone yelling "fire" in a crowded theater. We've seen this before. Historical parallels like the collapse of long-term capital management back in the day show us exactly how this plays out. They made brilliant bond arbitrage bets, but when volatility spiked, they couldn't sell off their assets to free up capital. Their collapse taught us a brutal lesson. Being mathematically right on a yield convergence doesn't matter one bit if the market suddenly freezes. If you can't survive the interim, you lose the whole game. Moving on to section 2, the liquidity mirage. Let's talk about flash crashes and shrinking order books and the hidden decay behind these yields. To understand this decay, we have to talk about a critical metric called the spline spread. Basically, this measures the average fitting error across the yield curve. And right now, in 2026, it is flashing some severe warning signs. High spreads act as a proxy. And what they're telling us is that arbitrageurs are no longer able or willing to do their jobs. Think of arbitrageurs as the market's shock absorbers. When they step away, market depth gets structurally impaired, and true liquidity becomes nothing more than a mirage. On the surface, things might look pretty normal. You've got an upward sloping curve, the 10-year sitting around 4.44%, and 30-year breaching that psychological 5% barrier. But beneath the surface, the duration of long-dated bonds has become a massive liability. Because the order books are so incredibly thin right now, a tiny little move in yield generates a massive move in price. It leaves the whole market incredibly prone to flash crashes and sudden liquidity holes. Underneath this curve, the primary engine driving this 2026 liquidity crisis is what's called the term premium. This is just the extra return you demand for taking on the risk of holding a long-term bond. Right now, that term premium is undergoing aggressive expansion, and it's being driven higher by massive fiscal anxiety over the U.S. deficit, combined with multipolar geopolitical shocks that have just completely scrambled the old safe haven playbook. And this local issue is quickly compounding into a global one. Historically, foreign central banks would just seamlessly recycle their trade surplus dollars back into U.S. treasuries. But the 2026 trade deficit data shows a massive shift. The nations accumulating dollars now, like Vietnam at $19 billion or Taiwan at $17.3 billion, have entirely different reinvestment priorities than historical giants like China or Japan. So that traditional super reliable buyer mechanism, it's effectively broken down. Which brings us right into section 3, the auction, death spiral, and fiscal dominance. This breakdown in demand forces a very harsh mechanical reality. So mechanically, how bad is it? Well, just look at the primary dealer absorption rate. For the recent 2-year note, we saw a massive 24% dealer absorption. When end investors step back from weak auctions, Banks are literally forced to swallow the debt onto their own balance sheets. We are also seeing high auction tails, which basically means the actual yield the debt sells for is significantly higher than the pre-auction trading price. It's a huge red flag. The brutal truth is that the Treasury is basically trapped. They are mechanically forced to issue unprecedented amounts of debt into a highly fragile market. We're looking at a $1.9 trillion projected deficit for 2026. That's roughly 5.8% of GDP. Add to that the 2025 Reconciliation Act adding $4.7 trillion over 10 years, plus revenue gaps from shifting tariff policies. The supply of debt is exploding right at the exact moment demand is shrinking. All right, Section 4, bonds versus Bitcoin. With the system under this much strain, we really need to dismantle an antiquated assumption about risk. Let's dive into this because retail investors are blindly trusting this antiquated view that the long bond is a safe harbor. I mean, imagine telling an investor 10 years ago that U.S. Treasuries would carry more price risk than crypto? No way, right? But that is our 2026 reality. Long-dated Treasury implied volatility frequently rivals and sometimes actually exceeds the 30-day volatility of Bitcoin. Retail is out there just buying the dip, completely ignoring this massive paradigm shift. And the numbers absolutely confirm this shocker. Thanks to the ETF effect and its maturation as a global liquidity proxy, Bitcoin's volatility has compressed to just over 4%. Meanwhile, the long bond ETF has seen its implied volatility skyrocket to a peak of 18.2. Think about that. The supposedly speculative asset has stabilized, while the bedrock safe haven is swinging wildly with extreme fat tail volatility. So the crucial takeaway here is that holding duration risk without a liquid exit exposes you to equity-like drawdowns. A sustained 100 basis point jump in yields, that equals an 8 to 9% capital loss. And worse, bonds lack the V-shaped recovery of something like Bitcoin. Historical cycles show us that bonds can take over a decade to bounce back. The traditional role of the bond as a portfolio diversifier is just fundamentally broken right now. It's essentially become a direct, highly volatile bet on U.S. fiscal solvency. So, Section 5, the escape plan. How do we navigate this? Let's talk about short duration ladders. What we're seeing right now is a clear institutional pivot away from the long end of the curve. Smart money is using short duration ladders to hedge their exposure, funds keeping maturity under 1 year or rolling 1 to 3 year ladders. This strategy minimizes your duration pain, locks in predictable cash flows, and most importantly, maximizes your liquidity. If rates rise, it's no big deal. You simply reinvest those matured short bonds at the new, higher yield. To actually execute this, institutional strategists recommend breaking the next 90 days into specific seasons. For the first 30 days, the goal is a step-by-step reduction in duration, possibly shifting funds into inflation-protected securities. Then, in the next 60 days, you aggressively build what's called a zero-duration margin of safety. You park that capital in cash-like, high-quality liquid assets, like 3-month Treasury bills. Because, as industry analysis keeps highlighting, when the market enters a true liquidity vacuum, breathing room is infinitely more valuable than chasing an extra 0.5% of yield. Seriously, if you are forced to sell a long-duration bond into a market with 0 buyers just to meet a collateral call, the losses will absolutely wreck your portfolio. It always comes back to this timeless reminder from Keynes, doesn't it? Markets can remain irrational longer than you can remain solvent. You might look at the macroeconomic data and feel absolutely 100% certain that rates must eventually come down. But holding a theoretically sound long position means absolutely nothing if a locked, illiquid market drains your solvency before that reversal ever even happens. So I'm leaving you with this final thought for your own portfolio. If the ultimate safe haven locks its doors, are you actually positioned to survive the 90-day danger zone? The paradigm has shifted entirely from rate tools to liquidity tools, because in 2026, the absolute safest way to buy the dip is to buy the instruments that simply don't dip. Protect your liquidity out there, stay vigilant. Thanks for joining me on this explainer, and I'll see you next time.